In an equilibrium, we expect a stock's price and its intrinsic value to be the same. Remember, intrinsic value essentially means the stock's true price, the stock's true value. In the market, prices and values aren't always the same. Sometimes the market just kind of get things wrong. Our theory is that in equilibrium, prices and values are the same, and that prices and values will reach that equilibrium over the long term. So in the long term, prices and intrinsic values should be the same thing, but in the short term, prices and values may deviate from one another. From an investor perspective, what they have, an investor has a reason to try to determine what intrinsic values are, because they want to know which stocks are attractive to buy or sell. And so if a stock is above its true value, if a stock is priced at above its true value, then it's overpriced and you would want to sell it. But if a stock is priced at below its true value, then it's underpriced and you want to buy it. So overvalued would be a sell. Undervalued would be a buy. Managers need to understand intrinsic value because they need to know how their alternative actions are likely to affect stock prices. And so essentially the manager's goal, again, is sort of maximize shareholder value. So what they want to do is keep these intrinsic value models in mind to see how they can maximize the value of the firm. They should also consider whether the stock is undervalued or overvalued when making certain decisions. And one of the big ones is issuing new stock. When a manager issues new shares of stock for the corporation, what they're going to want to do is raise some capital. And if the stock is underpriced, the price is too low, they wouldn't be raising as much capital as they should given the stock's true value. So if the stock is underpriced, they wouldn't want to issue new shares. But if it's overpriced, they would be getting more capital for every share that's issued. And so they have more incentive to issue new equity when it's overpriced. So issuing new stock, what the manager would want to do, issue when price is greater than its intrinsic value, and not issue when the price is less than the intrinsic value.